Hello everyone. Okay, let me introduce myself first. My name is Nimas Ajeng Rahayuningsih, and you can call me Nimas. I'm from Accounting Department, Faculty of Economy, Tidar University. On this occasion, I would like to explain one of accounting cycles, namely closing journal entries. Every financial transaction goes through an accounting cycle, a multi-step process that records, summarizes, and organizes your transaction into financial statements. After most of the cycle is complete and financial statements are generated, there's one last step in the process known as closing your books. Closing entries, also called closing journal entries, are entries made at the end of an accounting period to zero out all temporary accounts and transfer their balances to permanent accounts. In other words, the temporary accounts are closed or reset at the end of the year. This is commonly referred to as closing the books. The purpose of the closing entries are to prepare a company for the next accounting periods by clearing any outstanding balances in certain accounts that should not transfer over to the next periods. Closing or clearing the balances means returning the account to a zero balance. Having a zero balance in this account is important, so a company can compare performance across periods, particularly with income. It also helps the company keep true records of accounts balances affecting retained earning. Revenue, expense, and dividend accounts affect retained earning and are closed so they can accumulate new balance in the next period, which is an application of the time period assumption. In recording the closing entries of a trading company, there are generally two methods used: periodic method and perpetual method. Periodic method. This method is widely used by companies that sell goods as retail at more affordable price, where the recording is done at the end of each period. Perpetual method. For companies that sell goods at a high value, it is more suitable to use the perpetual method. The reason is that this method is carried out in detail and continuously for all transactions, so the recording must be in more detail. Components of accounts in making closing entries are temporary accounts. Temporary accounts include 4 accounts: revenue accounts, expense accounts, the income summary accounts, and dividend accounts. Accounts are considered temporary when they only accumulate transactions over one single accounting period. Temporary accounts are closed or zeroed out so that their balances don't get mixed up with those of the next year. Many steps can be followed to make closing entries. The first one, close revenue accounts. Revenue accounts are transferred to the income summary. This is done through a journal entry debiting all revenue accounts and crediting income summary. Two second steps. The same process is performed to expense. All expenses are closed out by crediting the expense accounts and debiting in the income summary. In the third step, the income summary account is closed and credited to retained earning. And finally, if dividend was paid out, the balance is transferred from the dividend accounts to retained earnings. Dividends are profit franchises of investor according to an agreement. In conclusion, with closing journal entries, all accounts would return to zero position. Then we'll prepare for starting registering and report financial statements of the trades company, service, and manufacturing for the next year. So, as the company can evaluate its performance for the previous periods and then can renew the strategy to management.